And happy Tuesday, everybody. And yes, we are changing our Instagram live a little bit. Just this in next week because I am scheduled with some travel plans, but David is still generous enough to join us and to join us with his time. So today we're going to talk about how to lower your monthly payments, and David actually prepared to present to us several different options now in today's day and time on how to lower your monthly payments. And here's David. Hi, David. How are you?
Morning, Alexandra. I'm doing really good. Good morning, everyone.
Excellent. And we are excited to hear the latest news in the mortgage industry, along with the topic of today's conversation. How can the borrower in today's market with the crazy interest rates actually afford to lower those payments? Like, if you could give us some hints on what are the common ways to do it.
Sure. Okay, so what a mortgage is, it's a 30-year, most of the time it's a 30-year payment, which is, it's broken down into 360 fixed payments multiplied by a certain percentage, which would be your interest rate. Okay, so lowering the interest rate is the number one most common thing. Lower the interest rate, which means you're going to pay less interest every month for this transaction. That's called a refinance. A refinance means you go through the same process. A lot of people are mistaken. They think that they could just call the bank, hey, can you refi me? Or you need to apply for a new loan, a brand new loan. The process is the same. And once you're approved for a brand new loan at a lower interest rate, then the bank will basically flip, the new loan will pay off your old loan. That's a refinance.
So, David, let's say if I'm going for a loan right now, whether it is a conventional loan or an FHA loan. Let's say if I were applying for the conventional loan, 10% down today, what would be the par rate? My credit score is 720. So tell me what
I try to stay away from quoting rates.
I'm not trying to ask you to quote rates. What I would like for you to explain to us, how do you know what your rate is going to be? How do you tell me the rate? First of all, if you and I apply for the same amount today, but we have different credit scores, we have different credit history, but you and I are looking at the same home and we're submitting an offer on the same home, will you and I have the same interest rate or no?
Great question. So Fannie Mae has what's called LLPA, loan level price adjustments. This has been on everyone's mind. I get text messages from clients. I get text messages from realtors. This gets politicized, but what you really need to know is loan level price adjustment means there are different factors at the loan level that affect your interest rate. One of them would be your credit score. So if you and I have different credit scores, that's going to affect our interest rate. The other one would be, and one of the bigger ones would be your down payment. That may have an effect on your interest rate you qualify. The other one would be the type of property you're buying. A single family home would have a different LLPA adjustment than a condo, for example, or a fourplex. So that would be another LLPA. So again, these are factors that change your pricing interest rate.
So if I go online right now, if I Google what is the interest rate right now, and Google tells me today's 30-year fixed is 7.125.
Sure.
So, and I'm like, David, it's too much for me. How can I lower it?
Yes.
Can you give me the options of lowering it?
Yes.
What can I do today? Let's say I would buy the house if I could have it at like 6.5.
it would be more comfortable for me,
Yeah.
or the payment would be more comfortable. How can I get 6.5 today when it says that the 30-year fixed is 7.125?
Sure. So when we have the client at the conference room, we open the rate stack, right? So rate stack means there are different rates all the way going from 4% to like 8%. The rates are broken down into 0.125, 1/8%. So once we have the rate stack, I'll tell you, all right, Alexandra, you're at 7.1. Now, where do you want to be? A lot of times people have this arbitrary number. I think 6.5 is 6 here to me. Okay, let's shoot for 6.5. And anything below your par adds cost. The lower your rate, the more the cost. 6.5 would have an X amount, and a 5% would be much more expensive. So the way you calculate this is the question people ask, David, should I do this? Obviously, it's extra cost. I'm increasing my closing cost. Should I pay money to lower my interest rate? My answer is going to be, I think rates are going to drop next year. I think you're going to get this rate without paying anything if you refinance next year. Will you break even next year? We don't know. So let's calculate this. We take the cost, 6.5 costs $2,000, for example, and you're saving $200 a month. All right, $200 a month, 2,000 divided by 200 is 10 months. You will break even in 10 months. You should absolutely do this. Does that make sense? So whatever your monthly savings are, okay, and whatever the buy down cost is, you divide that to understand your break even period. If you're going to break even in 8 years, there's no reason you should do a buy down.
That makes sense. So for the buy down, for those who are just starting on their journey.
Right.
So the buy down, this is the process when the buyer at the beginning of the entering into the contract can actually pay a certain amount to the bank to actually not accept the interest rate that is currently offered by the market, but this is at a certain price point, the buyer can lower the interest rate that will be fixed for 30 years. And this is the permanent buy down that you're talking about, correct?
Correct. So you have, obviously, and you and I have covered this extensively, the temporary buy down, the 3-2-1, the 2-1, those are the temporary buy downs that are good for 3 years, 2 years, whatnot. But I was referring to the permanent 30-year buy downs. Instead of having 7.1, you could choose your rate. It could be 6.5, could be 6.25. We did one this morning. She didn't like her 6.7. She wanted a 6.25. She paid for a 6.25.
Now, tell me how, like, if I'm buying a $300,000, if my purchase price is $300,000, or if my purchase price is $500,000, would that buy down be different? Would that buy down be priced differently for a purchase price of $300,000 or for $500,000?
Yes, the buy down very much is affected. It's a percentage of your loan amount. So a buy down for a $100,000 loan and a $300,000 loan is going to obviously the percentage is going to be different, so it'll be more expensive, of course.
Okay. Don't kill me, but I'm going to ask you the question that everybody's asking me.
Okay.
They're like, if you can buy down, why nobody's buying down to 3%?
There is a limit.
Everybody wants a 3%
Of course,
interest rate.
the most banks limit the rate sheet. The minimum rate that we have is usually 4.7, 4.8. So you cannot go down to 2 or 3 if you wanted to. But 4.7, 4.8 on an average $350,000, $400,000 home is going to cost roughly about $25,000. And
you can buy down to it. It's
yes,
just
you can.
It's
going to be very expensive. You will save money, but your break-even period gets longer and longer. The more expensive the buy down, the longer the period. So most clients are extremely smart. They're very shrewd. So the banks are. There are some thresholds where it's very competitively priced, where they want you to buy down, which would be between 6.25 and 6.5. Those are relatively cheap to buy down to. It's optimal. The bank wants you to buy down. Anything below that, it becomes more and more expensive, where your break-even period goes away from you. If you're going to break even in 8 to 10 years, there's no reason for you to do a buy down, in my opinion, because rates will drop. You'll get that rate for free.
So can you give me 3 reasons why you would purchase the interest buy down today, and 3 reasons why you wouldn't purchase the interest buy down? Because we have people on both sides of the fence, and I know that you can talk on both. So give me the reasons why would you purchase the interest buy down today?
Okay, when you get a buy down, I guess the biggest question is who is paying for it? I know you have been really successful and aggressive in getting money for our sellers, which means if the buy down's coming from the seller, then of course we're going to apply as much of it as possible to try and lower that interest rate as much as possible. We recently had a situation where the client, we offered him 6.25. He was very happy with that, but the seller had so much concessions. The seller gave so much money that we ended up buying it down to 5.8. He was just ecstatic. It was just unbelievable. So yes, if the seller's
And can I ask you one question?
Please.
Like when you have it at 5.8, when you buy it down to 5.8.
Sure.
This is probably the interest rate that you would keep through the lifetime of the loan and never invest into. That sounds like a very reasonable interest rate by now, correct?
Yes, but we don't know. We'll see.
Or it is all going to be like the price of affordability. Like if you can afford to refinance and get a lower rate, go ahead and do so.
So let's say you and I are in 2024, a year from now, rates are at 5%. Rates are at 5. He calls me, David, I got 5.8. It sounded really good back in the day, but right now rates are 5. I want 5. I don't want 5.8. So what I'll do is I'll look at his closing costs. Every refinance has closing costs, and people have to be conscious of. Okay, a lot of times our industry will refinance you several times on that slope, and I mentioned this last week. Okay, they'll refi you at 6.5 and 6.25 and 6 and 5.8 and 5.5. Every time you get a refinance, you're adding that closing cost into your balance. Okay, it's very, very important to acknowledge that. Okay, so how much is your closing cost? How much is your monthly savings? I really don't care about the interest rate. What I care about is how much is my client saving per month. If the client's saving an X amount and he's going to break even, my job is to tell him, hey, listen, with this refinance, you'll break even in 24 months. It's like, yeah, are you going to keep this house for longer than 24 months? Yeah, David, I'll keep this house for 7 years. Our family likes this house and we don't see any moves. Wonderful, let's refinance you. You will break even with this cost that you're going to incur for the closing cost, and in year 3 you're going to be positive in savings. By all means, you should do that. I guess the only thing I would tell people is do not hurry with a refinance, because once rates start dropping, they're going to drop slowly over a long period of time. Feel out the bottom, refi once, don't refi every 3 months just because you're getting a 0.25% betterment on the rate.
And I think this is an excellent advice, because people are so focused on the lower interest rate that they have no idea where's the perfect number, or what is this perfect margin between the existing interest rate and the lowering interest rate in order to start the refinance process.
I just tell people to talk to me. Just talk to me. I'll tell you.
Absolutely. And if you guys, you don't have to understand you don't have to understand all the logics behind how to calculate when you're going to break even. All you need to do is to contact your trusted loan officer, who's going to actually lay it out for you and convert it into the real money if you want to, convert it into the time frames, how many months, and also he will ask you the right questions, because David actually said it very well on it, and this is what a lot of people miss out on. I had people coming to me and say, oh, we're thinking of refinancing our house. And then, I'm like, wonderful. What is, how long are you going to stay in the house? And they're like, oh, we're going to be moving out next year, because we're moving, our kids are out to college, we're moving. And I'm like, no, it doesn't make sense.
No,
it doesn't make sense for you guys to invest all this money and refinance unless your interest rate was 12. So it is very important to know your further future plans for the house and at least approximately how long you're going to keep the house. You might be moving out, but still keeping the house as a rental. That's a different story. So we got number one reason, why would you refinance? Why would you buy down the interest rate? To have a lower interest rate, and because the seller is paying for it. I guess we got two reasons for you from you now. If the seller is paying for it, we absolutely have to use this money, correct?
Yes.
Because and this is another question that I get a lot. Like, we do fight for every single dollar from the seller from the sellers to actually contribute towards our buyers and buyers' closing costs. But I would like for you to elaborate on, when we get that money from the sellers, what can we do with the money? Like, it's not like first of all, I had a client ask me, they're like, are they going to cut me a check? Because there are some states where sellers can actually cut you a check at the close of escrow. And we're here in Nevada, and this is not how we practice. You're not getting a single penny out of escrow from the seller. Like, we're not cutting the checks back. You guys need to be very aware of it.
Yes, so anything that's extra, that's not used, goes back to the seller, which is why, since we serve our buyer, and our allegiance, so to speak, is to our buyer, we're going to use up that money all as much as possible. We're going to basically, you cannot, first of all, the first question is, David, can I apply towards my down payment? Unfortunately, you cannot. The down payment has to come from you. As far as closing costs go, yes, you could definitely apply to closing costs. Some lenders, some banks will let you prepay for taxes, prepay for insurance. Most
For
don't.
HOA.
HOA.
But we have to do it upfront.
Yes, but a lot of banks don't. Funding departments, the funders, underwriters are not okay with it. This is an internal overlays that banks have, and if that's not something that they're allowing us to do, we're going to dump all that money into buying down the interest rate. It's free money. It's going to go away. We're going to lower the rate as much as possible.
So to reiterate on it one more time, when we have the seller concessions, things that we can use the seller concessions for. Number one, your closing costs. So all the costs that are associated with obtaining the loan, you can actually use that money. You can cover 100% of your closing costs with the seller money. Am I correct?
Correct.
So number two, you can buy down the interest rate from the money using the seller. If it's not enough, you can add more of your own money to buy down that interest rate. Is that correct?
That's correct.
Now, we can possibly use this money for shopping, for the, prepaying for the other items, but A, it has to be disclosed, B, it has to be approved by the bank ahead of time, and it has to be on the closing statements. Those things can be, you can possibly prepay the taxes, you can possibly prepay the HOA dues, you can possibly prepay the you can possibly pay for the home warranty if the seller is not buying one for you, and also for the properties that carry seed and lid balance, we can actually apply those that money towards lowering the seed and lid balance if there is an actual assessment balance on the property. We had once tried to apply this money towards the balance on the solar panels, but we actually got a kickback from the lender, and the lender did not allow us to apply that balance towards this solar panel balance.
That would be nice.
It was, we took a shot at it, but like you said, the underwriter or the closer, whoever it was, they came back and said, no, we cannot use that money. Absolutely not. So we got to give, is there another reason why you would buy down the interest rate right now?
Honestly, I don't know. You tell me. I can't think of anything. The only reason, the only reason you spend money to buy down the rate is to get lower closing costs. So once we do the break-even analysis, it either makes sense or it doesn't. I don't have any more hidden.
I will tell you,
Help
like,
me
I
here.
will tell you what comes from our customers is, let's say we had Alexander who actually told me, he's like, I want to know, I want a sense of security for the next 30 years. I want to know how much my payment is going to be. And I'm going to buy it down today to the point, and I will be comfortable. So it is a sense of security. It is the sense of comfort that you receive when you know you have a 30-year mortgage and you know exactly what your principal and interest payment is going to be till the end of the day. And if you decide to never touch your loan again or to never buy another property, you already know, like 29 years from now, your principal and interest payment is going to be the same. And that is, like, that is the way of thinking. And you can, if this is something that makes you comfortable, I'm absolutely for it. I know, David, you're not for it because you were.
No. I've been doing this for 18 years, and the longest mortgage I've ever seen was 15 years old. I have never seen anything older than that. Mortgages are no one keeps a mortgage for 30 years. No. So don't make that projection.
People,
You do?
I know two people who actually made the last payment on their mortgage and on 30-year mortgage.
Oh, Jesus Christ. Yeah, so that's not in Las Vegas, on average, people move between 5 and 7 years. So, so people are going to move. Dimitri, hello. What's up, my friend? So that's one. People are going to move, they're going to upgrade, they're going to downgrade, they're going to do something with it. We have very cyclical markets, which means you're going to refinance and actually get money out of that thing, pay some credit cards off. Rates will drop. You'll refinance for a cheaper rate. I remember this client. He paid $8,000 out of pocket right before COVID. And but he was buying a house, and he paid $8,000 out of pocket just to have a really low interest rate. I think he went down to from 5 to 3.7. And when I asked him, why'd you do this? He said, well, next time when I'm in some sort of a company, we talk about mortgages, I'll tell him I have this rate, and David did my mortgage. I'm like, I appreciate you spending so much money to be able to advertise me. And what happened is 4 months later, we had COVID, rates were 2.5. He refinanced again. He never really recouped that money. And he was okay with it because he got 2.5. I'm sorry, I have my views.
No, that's your point towards why wouldn't you do it?
No,
because
you wouldn't do it.
If you believe that the interest rates are about to drop or going to drop in the nearest future, you wouldn't buy down the interest rate.
We had no
correct?
notion of COVID. We had no idea COVID was going to happen. What we do know today, Alexandra, is rates are peaking. I think most people would agree with me that rates are peaking. They're up there. They're north of 7%. Okay, this is 40-year high, right? So anywhere rates go, chances are they're going down. If rates are good, chances are the rates are going to be heading down. Why would you pay for them for that low rate? Just hold on, keep your money.
I mean, here's the deal. I don't think that you or I have the crystal ball and we can predict when or whether they're going to go down. But we know that the rates go up and down over the time. So depending on all the information that all of our listeners have, they can figure out and they can bring this number to you. Let's say if I were to come to you and to say, David, I do think that every 4 years, right before the election, the interest rates go down. This is what I've seen, this is you can look at the interest rates, you can look at the exactly by the years when we were, when we have the election, and you can look at the year, at those years, every 4 years, correct?
Yep.
Every 4 years, starting June, look what is happening. And if you see the trend there, once again, I'm not predicting, I'm telling you what I've seen. I've seen the trend. So if I believe that by June this year, something is going to happen, and I come to you and I ask you, David, what is going to be my cost? Like, what am I going to overpay if I don't buy down the interest rate right now? Or I wait, let's say, for like till June next year.
Right.
Like, can you calculate that for me? What I would overpay if I don't pay the interest, if I don't buy the interest.
Of course. Well, yeah. But that would be the monthly saving difference for 12 months, whatever that would be, and you would compare that to the cost of buying down the rate. So go from 7 to 6. What is the cost? What's the monthly savings multiplied by the period? 12 months. This is what you're standing to spend out of pocket. This is what you're facing to save. And if it's less than 12 months, by all means do it. If it's not, then we're gonna do what clients ultimately want. Okay. So
give me more reasons why you wouldn't buy down the interest rate right now. Is there another reason why you wouldn't buy down?
If the seller wasn't paying for it, I would invest my money elsewhere. I would not buy the interest rate down. And you know me, the higher the interest rate, the more interest you're paying, but you're also deducting the interest on their taxes. So there's several factors you want to look at, do a deeper dive. I just think but on the other hand, Alexandra, if it's all going to come down to the break-even period. If you break even in a short period, then why not? Because again, if you're going to refinance next year, you're going to have a refinance cost, right? So if I can avoid a refinance, get a good rate today, oh yeah, I want a good rate today, so I won't have to refinance next year, by all means.
So if I am pretty confident in my mind that the interest rate is going to go down next year, and I do have an extra $10,000 in my pocket.
Sure.
How should I use it?
Well, I'm not
like in real estate. No. I'm not asking you. Like, I'm not asking you to which cryptocurrency to, or which. Like, should I apply it towards the down payment instead of buying down the interest rate, or should I just, like, leave it? Like, is it any benefit to me to apply it towards my down payment, or should I still think of buying down the interest?
That's a great question. The past tax person, the bookkeeper in me, wants to educate people on the concept of balance sheet. Balance sheet means your worth, your net worth. You have $10,000 in your checking account, you spend it on the house, you put a bigger down payment, borrow $10,000 less, which means, first of all, your loan payment will be $10,000 less. You immediately build yourself a $10,000 equity. You still have the $10,000 in form of equity. It's less liquid. You can't pull it out whenever you want, but you still have it. You just changed in your balance sheet. You changed the asset class from liquid cash to equity. I love equity because we can't spend it that easily. It's there, and we pay less interest. So I would probably, in this case, apply. Again, every case is different, but I would think hard about applying the extra money and borrowing less from the bank.
Okay, so for those people who are paying mortgage insurance,
yes,
who are putting, like, first of all, at which point of the loan does the mortgage insurance kick in? Like, how much down am I putting to pay the mortgage insurance and not to pay mortgage insurance?
Okay, mortgage insurance is only with conventional loans. Okay, that's important to understand. And excuse me, FHA as well. With FHA, it really doesn't matter what the interest, how much down payment you're putting. You could put 50% down. You're still going to have mortgage insurance. We don't talk about FHA. FHA always has mortgage insurance. With conventional loans, if you do 20% down or more, you don't have mortgage insurance. So most people think of 20% as the minimum down payment. You can buy a house with 3% down, with 5% down. If you do 3, 5, 10% down, anything less than 20%, you're going to have mortgage insurance. And when does it cancel, you asked?
Yes. Like when does it kick in, and when do we cancel the mortgage insurance if we do ever?
Sure. So mortgage insurance, you have two options. You can have a monthly, that the lump sum mortgage insurance is a lump sum. It could be broken into monthly payments, or you can pay it up front if you so want. You could make a big payment, $5,000-$6,000, pay the mortgage insurance off, and not have a mortgage insurance in your monthly payments. Again, lots of consultations from a good loan officer to see which one's better for you. Mortgage insurance gets canceled when you build 22% equity in your home and 2 years after you've been making payments. So 2 years later, cannot be 6 months, cannot be a year. 2 years later, you call your bank. Hey guys, I think my home appreciated 20%. Can you please remove my mortgage insurance? The bank will send an appraiser, get the value, and if you do have 24 months of mortgage payment, and if you have 22% equity, your mortgage insurance will be removed.
Once again, so you have to make the payments for 24 months. That's understandable. Now, does it make sense to pay it up front, or should you wait? Let's say I am putting in 15% down. Should I pay this mortgage insurance up front, or should I actually make 2 years of payments and see if my house appreciates?
If it was me, I would probably make the 2-year payments, because the upfront payment is usually going to take you like 10 years to cover. So I would say 90% of the time I would pay the monthly payments included in my mortgage payment. And I'm a big proponent of holding on to your money.
Then another question would be, when you pay up front, is it cheaper or no? Do you get a discount for paying it up front?
No.
You're still going to,
No.
Is it still going to be the same amount?
But here's what you can do. Paying up front is a very powerful tool, Alexandra. It was a very powerful tool back in 2021 for someone that would do, say, 20% down payment. We're going to have a 2021 on our hands, I think, within the next year. We're going to have a crazy frenzy of real estate just going up. Now, imagine a situation, someone's putting 20% down, and that's all they have, and the appraisal comes in 10% low. Mm-hmm. Now you don't have an extra 10% to put down. So what you do is you put 10%. Instead of 20, you finance 90%, you pay the difference in your appraisal value, and you pay off the upfront mortgage insurance, which is not going to be a big number. Does that make sense? So upfront mortgage insurance was a very powerful tool when we dealt with appraisal houses not appraising a couple of years ago. That's not the case now.
And does the payment of upfront mortgage insurance, is it tax deductible or no?
The mortgage insurance, I believe, goes on your taxes when you do your taxes. So you want to take your closing disclosure, settlement statement to your closing disclosure to your tax person, and they'll deduct it on your taxes.
And this is something that we make sure that we do every single year. Everybody who closes or has a transaction within the Nevada Realty Experts, you guys are getting all of your closing statements once again. Besides getting it through the transaction, at the time of the transaction, you're going to get them in the email or mail, however you want them. But you are going to get them once again before your tax season, like before the end of January. You're getting all of your closing statements, so you could actually take them to your CPAs, tax preparers, anybody who works with your taxes. Same thing, if you ever miss on yours, or lose it, you know where to get it, and it is absolutely free. By law, we keep them for 7 years, but by the nature of our business, we actually keep them forever for you. So you guys don't ever have to store them or think about where they are. they're always in our possession, saying we're happy to send them to you, and it never costs any money for us to send you your
Here's
closing statements or any documents.
something you and I should do. We should just make a list of people and call them in December. Our past clients that have bought a house in 2023, and remind them about the closing disclosure. Send them a copy, and also we need to tell them to be very, very diligent. Look for that first mortgage payment bill in January that will have their 1098 statements as well. So I'm thinking about doing a call in December to sort of help them out, prepare them for the upcoming tax season.
I think it's a great idea. And now that you talked about it, I have the next question to you. For those people who just closed on the homes within a month, and so they are getting, first of all, they're getting a lot of scam. Like the moment your property is recorded, you get bombarded by the mail and different mail pieces telling you that you need to pay here, there, you need to get a copy of your file for an exuberant amount of money, which you guys don't. Your realtor, doesn't matter who you closed with, your realtor, the escrow officer, you get these documents for free. Remember, all you need to do is to call your realtor, even if your realtor was not the one who you wanted, to talk to ever again. I'm sorry for your experience ahead of time. For those, for those who don't want to talk to their realtors after the transactions, or they feel like they were abandoned. Yeah, you can always call escrow, and you're entitled to all of your closing package documents for free. Anytime you can pick up the copies, it will be emailed to you in a secure email. But that said, the question that I had is that people don't know if it's a scam or if it is a true thing when they get the letter in the mail, like they have not made a first payment yet, but they're getting a letter in the mail saying that your loan does not belong to the brokerage, to the mortgage brokerage that you've been working with. Now you pay to U.S. Bank, or now you pay to ABC Bank. What is the proper procedure? First of all, how do I know, is it a scam or not a scam? What is the proper procedure, and how this gets handled?
Well, first of all, I guess the easiest answer I tell clients is talk to me. Any answer they have, my default answer is going to be talk to me. Once we close a loan, I would say majority, almost everyone, will send me pictures of the letters that they get. And they're like, David, what is this? Should I pay it? I tell them, no, read the fine line. There's always something that says we're not affiliated with your bank, that we're a for-profit organization, we're trying to refinance. So read the mail piecemeal, read the fine print. There are companies that buy information in bulk from the county and sell you certain documents that you have for free. Escrow will give it to you for free. So if you don't know what to do, whether this letter you got is your legitimate bank, talk to me. We need to also tell our viewers that a lot of times once a loan is closed, the servicing gets sold periodically. So this is a normal procedure in the industry. Lenders will buy servicing because the bank that originates and underwrites and funds your loan does not necessarily service your loan for the rest of the 30 years. Sometimes they bulk them up into a $50 million package or whatever, and then they sell them to other servicers. This happens. My wife goes crazy because you call the past bank that your account's closed, and
the new bank does not have it yet.
Doesn't have it yet. The auto payment mortgage went to the old bank. The old bank recognizes your phone number, says your account's closed with us, and hangs up on you automatically. It's fun. Unfortunately, it's the state of the mortgage industry. There's not much you can do here. Just gotta kind of go with it.
So the fact that your mortgage can be resold for the servicing to a different service provider or to a different bank, that is normal.
That's normal.
Correct?
Absolutely.
But if you get a letter like this, the best practice is to call your loan officer and to actually re-verify with your loan officer that this actually happened, and then you're not getting scammed by being given a different account information where to make a payment.
Yes. Call me anytime.
Go ahead. Sorry.
Well, this morning I had your client that we closed last week. She was asking, how do I make my payment? I haven't gotten a letter. Happens. We helped her. So it's normal. Just talk to your loan officer, text us. We'll find the answer for you. We'll always put you in the right direction.
For the situation like this, first of all, guys, when you are closing, when you're signing the paperwork, one of the papers in your closing package at escrow, and the professional escrow officers and the professional notaries who do deal with the transactions a lot, they will put it on top of your package. But I understand there is a lot of paperwork, so a lot of people just go straight into the shredder. There is no check. They go and put it into the shredder. Understandable. So you can retrieve your first payment coupon. You can always call and contact your loan officer and ask them when is your first payment due and where to make that payment. If you received anything in the mail saying that your loan has been transferred or sold, please re-verify it with your loan officer before you make any payments.
Well,
now remember, go ahead.
Well, if it's a brand new loan, you don't have a relationship, you don't have a contact information with the bank, with the servicing department, you definitely call me. You know no one else to call, so you're going to call me. But if it's a servicing department, you have an account number, you have a login, you've been making payments and your loan gets sold in 6 months or a year, then you have a phone number to a servicing department. You want to call them. They have more information than I do. You know, the truth is, once a loan gets originated and funded, it's out of our hands. Sometimes the servicing department may even change the loan number. So the loan number that we worked on is different. So you want to call your servicing department first in those situations.
Absolutely. For those people whose loans got sold, do they need to worry about any of the terms being different?
Never, never, never. If your loan officer told you that you got a fixed 30-year mortgage, you have a fixed 30-year mortgage. You obviously want to check your note before you sign at escrow. You have a fixed 30-year mortgage, which means your loan payment is not going to change. You may have some property tax increase, some homeowners insurance increase. This will happen. Homes get old, a roof gets old, your property insurance is going to go up. Property taxes go up to 3% per year. I try to look at property taxes, make sure the county is not charging them 8% instead of 3%. Periodically, I'll let clients know, for those that pay 8%, that they need to make the proper change to 3%. But your mortgage payment generally is not going to change.
Yeah, the principal and interest part is not going to change if
never
you have,
changes if it's a fixed loan.
You have a fixed mortgage. So for those of you guys who are a little bit more familiar with the paperwork, we would tell you that if you absolutely got lost the name of the bank, or it happens so that unfortunately that one of your relatives goes and cannot handle the paperwork on their own, and you need to retrieve that information. The information on the bank that owns the note is going to be in the note. So it is part of the closing package that the original borrower actually signed. Now, David, let's say if I know that somebody did the loan with you, let's say it's a relative of mine, and would you be able to retrieve, would the lender be able to retrieve the note for the family if needed to?
I did yesterday for your client. So yes, we'll do our best. First of all, escrow should have a copy, but yes, we'll be able to help you with that.
So for those for those of you guys who are in the position where you're taking care of the inheritance, maybe somebody passed away or something happens that the person in your family is incapacitated and you need this information, you can always go to the original lender. You can always go to the escrow company if you have any evidence of where the property was, where the documents were filed. For those of you who doesn't know how to do that, go ahead and call your realtors. We can retrieve, even if the transaction was done years and years ago, there are the documents that we can retrieve from the county and kind of track it backwards and help you out with finding the original lender's information if it needed to be, or any information that we can help you to and provide you in regards to your mortgage and making your payments.
I would even venture out to say that it's very, I don't know for sure, but I'm very, very highly certain that your current lender, even if it's been sold several times, should have the note. I mean, note and the deed are basic documents that if they're buying servicing rights to a loan, they should have the copies of those.
Excellent. So now we know that. And what else can you tell us about avoiding the scams with those documents when we just purchase the homes? What kind of mortgage scams do you guys see or hear? Do you guys deal with the insurances that the scammers are trying to send you, saying that, oh, we're going to insure your loan?
So a lot of times they call it, basically there are so many ways to sugarcoat life insurance, to it'll pay off if you die, whatever. Yeah, so that's illegal, to sugarcoat, to misrepresent a life insurance. The only important thing that I would tell my client to watch out for is the homestead. Homestead for first-time home buyers. If you're going to live in this house, it's you basically record your name with Clark County. We have homestead law, which means it's going to protect you for 5 years, that creditors will not be able to kick you out if you owe them anything. They will not be able to kick you out of your own home. This is something that needs to be re-recorded every 5 years. That's important to know as well.
Excellent. You see, I learned something new. I thought that it gets recorded once.
Nope, 5 years.
We
called and asked.
5 years you have to. Wow.
Yes.
This is the total news for me. I didn't know that. I thought that you recorded once. Now I have to make a round of calls for everybody who has the. Once again, this is for owner-occupied personal properties.
Homesteads.
You cannot record it for your investment properties, and you have to occupy those homes.
Mm-hmm.
And there's a certain amount that gets protected. I'm not going to quote the amount because it does depend on the county. It is different in every county, let's say, and in every state. Let's say the state of Florida, you will hear it that they have an unlimited homestead, so they don't have the limit of property or the estimated value of property that is limited. We do have a limit.
605,000.
605,000. Can you please do me a favor? I know you're Googling it right now. You're in front of the screen. So can you tell me what the state of California homestead will be? Because a lot of times with the people who live in between the two states, I tell them check it out and see who's which state is bigger. So that, you should have the homestead in that state if you live between the two states or three states, wherever your primary residence is.
All right. So the state of California just increased its homestead. It went from 300 to 600,000. Okay.
So California finally matched that.
Yeah. It's about time they caught up with us.
And something with the California property values, it's really nothing, correct? That's like a tiny condo somewhere deep in land.
Yeah. What else do you have?
Just tell me, what do you tell the people right now? Why would they buy? Like, why would they buy? How do you encourage the clients? What kind of fears you're dealing with?
There's two kinds of buyers. There's the first-time home buyer, and there's the someone that already owns a home, several homes, whatever. They're easier to make that decision. The first-time home buyer always has to make this mental leap from paying rent to owning something and being responsible for it. Sometimes they don't want the responsibilities, and sometimes the mortgage is simply more expensive and they don't see the value in it. They see the immediate savings of rent as more valuable. Sometimes they simply cannot afford, which means if you're renting a $400,000 house for $2,000, that to buy that house would probably cost you $700-800 more expensive. They just cannot afford it. And when I tell them buy what you can afford and live in it, they're like, no, David, why would I live in a $300,000 house, for example? It's a certain lifestyle. So it's a different conversation with first-time home buyers. It's more work with first-time home buyers and educational work. I built a special calculator that forecasts their net worth when they rent and when they buy a home, and that has been more successful in sort of moving the needle and explaining to people in a visual, logical way why they should own a home and not prioritize their rental savings per month, which is really, really, at the end of the day, doesn't matter how much money you save by renting. 5 years from now, you're going to have zero equity. And one of these days, if I lose my shame, I will go call my tenants and ask them what their portfolios are worth. And I will compare it to the equity that I've built in those houses that they have helped me pay off. It really comes down to numbers. And talk to a professional, break down the numbers, understand what you're standing to gain or lose by owning a house, and make a non-emotional, logical decision.
And I would say that every time the people get the courage and they make the step from being a renter to becoming a homeowner, and once they sell the house, like several years down the road, most of the time they think, I'm getting all this equity back because, all this money back because I paid off my mortgage, or I paid towards the principal. And the truth is, in 5 to 7 years, the average time that the person owns the property here in Las Vegas,
right,
because you don't really pay that much towards the interest, towards the principal of your mortgage, because you, the first years, you pay more towards the interest. The majority of your gain actually comes from the property value increase. And this process is getting compounded. And what I mean by this, there are two factors that I would like everybody who's on the edge of buying a home know. You can buy an asset. You can buy $1 million asset, for example, and put only $100,000 down. So you're buying with the 10% down. I'm just doing it for the ease of calculation. I'm not encouraging everybody to buy $1 million house. Buy what you can afford. But if you buy $1 million asset and you only put in 10% into down payment, so your asset is going to appreciate the entire asset. So your $1 million is going to appreciate. So your asset is getting the appreciation on $1 million. Meantime, your initial investment into it is only 10%. If you have this $100,000 and you put it into the long-term CD, it's going to maybe if you're lucky and you're a super duper, super loved client of your bank, they will give you 5% appreciation, maybe 4%. So, but you will only get 4% appreciation of your $100,000. If you have it built in the equity of the asset that is appreciating, like the entire asset, like $1 million home, you're actually getting 5% appreciation on the entire asset. And that's why it is so important for you guys to know that you get the benefit of the entire asset, not your initial down payment, but the entire asset value. And I think this is the main reason why, before you spend your money anywhere else, especially on rent, you should consider like how much the asset that you're buying is going to appreciate.
Archimedes, right? Give me 5% and I will get you 100% house. Isn't that what Archimedes said about leverage?
I guess so.
Yeah.
I didn't I didn't hear it, but this is what I think that this is what everybody needs to think about, and this compound effect of the appreciation, that your asset is going to appreciate by 5% or 3% if you're super conservative every year. Just keep it for 5 years and see what happens.
Yes. Absolutely.
And I think with that, we can wish everybody a wonderful week. And thank you again, David. Thank you for your time. Thank you for your explanations. And I do encourage everybody who is not sure which way to go or what to do to actually use David's generous offer of his time to sit down and talk and break it down, what the financial goals of your family are, and how to get there, how to become a home buyer. Maybe not today, maybe like 3, 6, 9, 10 months from now, maybe a year from now. But if you set this goal and you work with a professional to roadmap it for you, you can absolutely do so, and you wouldn't even care what the interest rates are.
Yes. The biggest investors really talk about the interest rates the least. That's not what's on their mind.
Thank you so much, David. As always, it has been a pleasure, and we're looking forward to, I'm sorry, we're not going to see you next week. We'll have to skip next week because I will be in between the planes.
Okay. All right.
But we'll have to prepare something really special for 2 weeks from now.
Okay. Thanks, Alexandra. Travel safe.
Thank you, David.
I appreciate this. Yeah.
Thank you.
All right.
Have a great week.
Bye-bye.
Bye.